Hello and welcome to today's lesson. I'm your hard-working but indefatigable teacher, Mr. Burton. You will need to watch this video and take notes as you go. You may need to watch certain parts of the video a few times to ensure complete understanding. This is your homework and I will check your notes tomorrow before we get started. I hope you learned something.
Okay, hello and welcome to today's lesson. Today we are continuing on with inflation and specifically looking at the negative effects of inflation. Okay, so why high and unstable rates of inflation are bad?
Venezuelans line up with bagloads of 100 Bolivar notes to exchange them for larger denominations. The notes are being taken out of circulation on President Nicolas Maduro's orders. He says the mafia is destroying the economy by hoarding cash for the black market, leading to runaway inflation.
The president needed to take these, of course, very correct measures and very welcomed by the people to put an end to this situation.
Maduro says new notes with much higher denominations, up to 20,000 bolivars, are already in circulation. But Venezuelans scrambling to exchange their soon-to-be defunct 100 bolivar notes couldn't find them, and the deadline is drawing near.
We were told we need to drop off the 100 Bolivar bills and get them exchanged, but we come to withdraw new cash and we get the hundreds again. I don't understand. It's crazy. I do not understand.
And the crisis has uncovered a new currency trend: metal. Just outside the capital, a telecom's tower tumbled after thieves stole the screws helping to prop it up. They also took copper cables and a generator. In these desperate times, industrial materials have risen sharply in value.
So far this year, we have had almost 600 thefts in about 330 stations. We've had stations that have been robbed more than once. The loss is almost $5 million. This money could have been invested in modernizing the network instead.
Welfare groups are reporting a spike in families struggling to survive because of the rampant inflation. Some are even handing over their children to friends or the state to look after. And food riots and looting are becoming more common as the situation deteriorates, with Venezuela teetering on the brink of chaos. Mar Sattar, Al Jazeera.
Just a brief introduction to the negative effects of high inflation there. Venezuela, the economy is going through some terrible times at the moment. Inflation running around about 700% per annum. Right, inflation and purchasing power. The percentage change in nominal income minus the rate of inflation gives us a change in real income. So, for example, if average nominal incomes in a country increased by 2.7% in a year when the inflation rate was 1.9, then the change in real income would only be 0.8%. Consumers, households would be better off by just 0.8%. Because inflation reduces the purchasing power of income. And that's because the amount of goods and services that can be purchased with any given quantity of nominal income decreases. Nominal income, that's just the income that you receive in your paycheck that turns up in your bank account each payday. So for example, if inflation increased 3% in 1 year, then every $10,000 of household income at the beginning of the year would purchase more goods and services than it would at the end. At the end of the year, it would take $10,300 for the household to be able to purchase the same quantity of goods and services. So the amount of goods and services the average household can purchase with the set amount of nominal income decreases and households are worse off. Consumer welfare decreases with inflation. Essential statement: the purchasing power of income will remain unchanged if the percentage increase in nominal income is the same as the rate of inflation. So people get a 3% wage rise, but inflation is running at 3%. Households are just breaking even. They're no better, they're no worse off. Inflation and saving. We define saving as being income not spent. Now households typically save with the bank. They deposit their savings with the bank and the bank will pay them interest on the amount that they've deposited. Banks are essentially borrowing money from savers It's the savers' money, it's not the banks. The savers are loaning the banks their money temporarily. And interest is a price paid by banks for the use of borrowed money. It is the money that households earn from their bank deposits. The nominal interest rate is the stated or advertised amount of interest that banks pay depositors. So that's the interest rate before taking inflation into account. The real interest rate is the rate of interest an investor, saver or lender receives after allowing for inflation. If banks are paying on average an average interest rate of 5%, prices are stable. Prices are stable would mean inflation is zero, no price increases, no price decreases. Then the saver will be able to purchase an extra 5% of goods and services when she withdraws her money within a year's time. Now the real interest rate then equals 5% and the purchasing power of her savings has increased by 5%. Of course, inflation is going to decrease her purchasing power. So if inflation causes average price in the economy to increase by 3%, then the saver will only be able to purchase an additional 2% of goods and services when she withdraws her money at the end of the year. The real rate of interest is 2%, and the purchasing power of her savings has only increased by 2%, not by the advertised 5%. And of course, if inflation runs higher than the advertised nominal interest rate, then the real interest rate will be negative and the purchasing power of savings will actually decrease. And the lower the real interest rate, the lower the incentive for households to save. And the lower the incentive to save, the more likely it will be that households won't delay consumption. They're going to bring forward consumption to now, spending income now rather than later. The real interest rate equals the nominal interest rate minus the inflation rate. Real interest rates take into account the effect of inflation and will determine the real purchasing power of the savings of households. So, step by step, increases in the rate of inflation decrease the real rate of interest. This decreases the purchasing power of savings, and with this comes with a disincentive to save. So it decreases incentives to save, foregoing consumption, and that increases the incentive to bring forward consumption. The redistributive effects of inflation. Real interest rates fall as inflation rates increase, and that causes a transfer of resources from savers to borrowers. This is because inflation reduces the burden of borrowing as it reduces the real value of the borrower's debt. So if a household has a $300,000 mortgage and inflation is 10%, then at the end of 1 year the value of that debt has really fallen by $30,000. And if we are a savings household, has the same amount of cash in the bank that it has in mortgage, then the real value of the savings would be $30,000 lower at the end of the year than it was at the start. So if the household consisted of a pair of pensioners who are counting on using their savings for their retirement, then their purchasing power is being reduced each year that inflation is greater than the nominal interest rate. Right, we've got debtors and creditors, redistribution here. So during periods of rising prices, debtors gain and creditors lose. When prices rise, the value of money falls, though debtors return the same amount of money, but they pay less in terms of goods and services. And this is because the value of money is less than when they borrowed the money. So the burden of the debt is reduced and debtors gain. Those that are borrowing money gain. On the other hand, creditors lose. Those that have money in the bank lose. Although they get back the same amount of money which they lent, they receive less in real terms because the value of that money is falling all the time. Thus, inflation brings about a redistribution of real wealth in favour of debtors at the cost of creditors. Wage and salary earners lose as well, because there's often a time lag between the raising of wages by employees and the rise in prices. Workers lose because by the time wages are raised, the cost of living index may have increased further. Fixed income group, we're talking about our pensioners here. The recipients of transfer payments such as pensions, unemployment insurance, social security, etc., and recipients of interest and rent live on fixed incomes. Pensioners get fixed incomes typically. All such people lose because they receive fixed payment, while the value of money continues to fall with rising prices. Investors, people who hold shares or stocks of companies gain during inflation. For when prices are rising, business activities expand with increased profits for companies. As profits increase, dividends on equities also increase at a faster rate than prices. And those who invest in debentures and bonds, securities, etc., which are carrying a fixed interest rate, lose during inflation because they receive a fixed sum while their purchasing power is falling. Business owners of all types tend to gain during periods of rising prices. So producers, the firms for example, when prices are rising, the value of their stocks rise in the same proportion. So they profit more when they sell their stored stocks. Business growth and employment. In times of high and unstable inflation, businesses become more uncertain. Inflation affects the firm's cost of production. They push up the prices of those factor inputs. It's difficult to make long-term business planning and pricing decisions when there's uncertainty about what the cost of production will be into the near future. If you're a business operating in Venezuela at the moment, it is a terrible time to plan. You just don't know what's happening with prices. So it becomes difficult to gauge the real returns on investment projects firms may be considering. Real returns, that's a return on investments after inflation is taken into account. So all things being equal, the higher the rate of inflation, the greater the nominal returns from investment need to be. And the higher the needed returns, the more risky investment projects become, which in turn lowers the average investment by firms in the economy. Now investment is crucial for long-term economic growth because long-term economic growth only increases if the quality and quantity of factors of production that will shift the long-run aggregate supply to the right and lead to higher levels of income and employment in an economy occur. So investment projects lead to increased capital stock, which leads to increased productivity within an economy, and without investment, full employment levels of output remain unchanged and can even decrease over time as capital becomes obsolete. Increases in capital stock will shift the LRAS curve right, increasing real output, incomes and employment. As firms decrease investment in an uncertain economic environment, i.e. when inflation is running high, the long run aggregate supply increases less, and it can even reverse, which would mean the opposite of what you're seeing here. The long run aggregate supply curve would shift left. Now remember, investment is central to aggregate demand. Aggregate demand equals C plus I is our investment, plus G plus X minus M. And investment is an injection into the circular flow of expenditure and income. Investment expenditure by firms increases AD, and that can be done by a multiplier as well, which will create additional employment, raise incomes and generate tax revenues for government. But in times of high inflation, when investment decisions are being put off by firms, they're uncertain about their investments, then aggregate demand is likely to fall as investment falls, and which leads to decreased investment, decreased aggregate demand, which decreases national income, output and employment in times when inflation is high and unstable. Investment reduces, aggregate demand drops. On the international stage, a country's international competitiveness depends in part on the rate of inflation within the economy. If a country has a higher rate of inflation than that of its trading partners, then that's going to make exports less competitive. Why? Because the prices of their exports are going to be higher. Inflation is pushing them higher, and will make imports from lower inflation trading partners more attractive. This can lead to lower export revenues and greater expenditure on imports, which worsens the trade balance and may lead to unemployment in export industries and industries that compete with imports. The decrease in international price competitiveness caused by inflation is going to reduce aggregate demand, shift the economy to a new lower level of employment and output. As exports decrease and imports increase, we get decreased aggregate demand. And I'm sure by now we can all model that. So if exports fall, imports increase due to inflation, there will be lower national income, lower output and lower employment in the economy. Aggregate demand decreases.